Hey there and welcome. When you look at a trading chart, it can often feel like you're just staring at pure chaos, right? But what if I told you there's a kind of hidden map, a set of pre-calculated levels that can bring some serious clarity to that chaos? Well, today we're diving deep into one of the most trusted tools in any pro trader's arsenal, pivot points. Let's get right into it. I mean, that's the million-dollar question, isn't it? How do the pros seem to know exactly where the big battles between buyers and sellers are going to happen before they even happen? Well, spoiler alert, they're not using a crystal ball. They're using a time-tested indicator that literally turns yesterday's price action into today's roadmap. So here's the game plan for the next few minutes. We're going to start by uncovering this secret map. Then we'll decode the simple math behind it. After that, we're getting super practical with 3 core trading plays you can actually use. We'll also cover the crucial stuff, like your defenses, look at pivots in the real world, and wrap up by helping you decide which map, daily or weekly, is the right one for you. Okay, so let's start at square one. What in the world are these pivot points we're talking about? The best way to think about them isn't as just another indicator, but more like a pre-built architecture for the entire trading day. At its heart, a pivot point is just a simple, objective calculation. There's no opinion, no guesswork, nothing subjective about it. It just takes the most important data from the day before, the high, the low, and the close, and spits out the average. That one number becomes this central point of gravity for the current day's trading. And this is where the real magic happens. From that one central pivot, your software automatically calculates and draws a whole series of support and resistance levels right on your chart. These lines show you, in advance, where the price is likely to hit a wall, find a floor, or just blast right through. It's a roadmap laid out for you before the market even opens. And this quote just nails it. Pivots help you figure out if you should be bullish or bearish. They give you these super logical places to set your stop loss to protect your capital. And they provide crystal clear targets for taking profits. They basically structure your entire trade from start to finish. All right, so we get that it's a roadmap. But how is this thing actually drawn? You might be thinking it's some crazy complex algorithm, but the truth is, it's beautifully simple. Let's decode that blueprint. It's really just a simple 3-step process. First, you grab the high, the low, and the close from the last period, so yesterday, for example. Second, you add them up, divide by 3, and boom, you've got your main pivot point, or P. And third, you use that p-value in a few simple formulas to generate all your support and resistance levels for the day. That's it. And here are those standard formulas. Now, don't get intimidated by the math. Your trading software does all this for you in a split second. The important thing here is to understand the logic. See how every single level is mathematically tied to what happened yesterday? That's why they work. That's why the market respects these levels so much. Now, just a quick heads up, while we're really focusing on the standard or floor pivots today, because they're the most common, it's good to know that other flavors exist. You've got Woody's, Camarilla, Fibonacci. They all try to do the same thing, just with slightly different recipes. But for now, we're going to master the original. Okay, this is where the rubber meets the road. We know what pivots are, we know how they're made. Now let's learn how to actually use this map to trade with 3 core plays you can add to your toolkit. So play number 1, and probably the most common one, is the pivot bounce. This is a classic reversal strategy. The whole idea is that these pivot levels will act like a concrete floor or a steel ceiling, and the price will just bounce right off of them. The most important word here is patience. So you see the price dropping down to a support level, let's say S1. You don't just blindly buy. No, you wait. You watch for the price to lose steam and then print a confirmation candle like a bullish hammer. That candle is the market screaming, hey, buyers are showing up here. That's your cue to make a move. But what if the price doesn't bounce? What if it just slices through a level like a hot knife through butter? Well, that's when we pull out our second play, the pivot breakout. This is all about momentum. So a powerful move through a level like R1 is a huge sign that buyers are in total control. Now, the aggressive way to play this is to jump in right away, but the safer, more professional approach is to wait for a little pullback. A lot of times, the price will come back to retest the level it just broke. When that old resistance holds as new support, that's your high probability entry to ride the momentum up to the next level, R2. Our third play is all about combining pivots with one of the oldest sayings in trading: the trend is your friend. This strategy uses the pivot levels to find really low-risk spots to hop on a trend that's already moving. And it's just plain logical, right? If the price is spending all its time trading above the central pivot point, the market's obviously got a bullish bias. So instead of chasing prices higher, you just patiently wait for the price to dip back down to a known support level, like the main pivot itself, and look for your buy signal there. You're basically buying the trend on sale. Okay, having a great map and knowing all the plays is awesome, but it's totally useless if you don't have good defenses. This section honestly might be the most important one. It's all about risk management and the mindset that really separates the winners from everyone else. Just take a look at this. On the left, you've got the patient, disciplined trader. They use pivots the right way, they wait for proof, they enter on a retest, they manage their risk. On the right, you've got the impulsive trader who gets totally chopped up chasing moves and trading emotionally in that empty space between the pivot levels. The bottom line is, pivots reward patience. Think of these as your non-negotiable rules of engagement. Your stop loss always goes just on the other side of the level you're trading. That's what protects you if you're wrong. Your profit target is just the next pivot level up or down. It's that simple. And I can't say this enough, avoid trading in the middle. That space is a trap. It's where uncertainty is highest and your odds are lowest. And here's a crucial reality check. Pivot points are amazing, but they are not a magic bullet. They become truly powerful when you combine them with other things like trend analysis, candlestick patterns, maybe another indicator. The more reasons you have to take a trade, the higher your chances of success. All right, enough theory. Let's see how this all works in the real world. It's time to step into the arena and look at these strategies on an actual chart. We'll walk through a couple of super clear examples. Okay, let's paint a picture with Bitcoin. The price is in a sweet uptrend, but it starts to pull back. And where does it stop? Bam! Right at the daily S1 support level. We don't buy yet, we wait. And then a perfect bullish hammer candle forms. That's our confirmation. So we enter just above the high of that hammer, our stop loss goes right below S1, and our first target is the main pivot point. See? It's all planned, objective, and super clean. Now let's do a breakout play, this time with gold on the weekly pivots. So gold's been struggling to get through that R1 resistance. Then, all of a sudden, a huge, powerful candle smashes right through and closes above it. We wait for the retest, price dips back down, kisses that R1 level, and holds. That's our entry. The old ceiling has become the new floor. Our stop goes just below R1, and we're targeting the next major level up, which is R2. This brings us to a final but really important choice you have to make as a trader. You see, not all pivots are created equal because they can be calculated on different timeframes. The two most popular by far are daily and weekly. Honestly, this choice really boils down to your personal trading style. Think of it like this. If you're a day trader getting in and out of the market on the same day, then daily pivots are your entire universe. They give you the key intraday levels you need. But if you're a swing trader, maybe holding positions for a few days or even weeks, then the weekly pivots are your guideposts. They mark the bigger, more significant turning points and give you that big picture view of the market. So as we wrap this up, the final piece of the puzzle is you. And I'll leave you with this question for your own trading journey. Which map are you going to choose? Will it be the daily pivots for those quick, nimble trades, or the weekly pivots for those major, game-changing turning points? There's no wrong answer, but knowing which one fits your style is a massive step towards trading with confidence and clarity. Thanks for joining me on this explainer.